Minimum wage in a perfectly competitive labor market. What is a perfectly competitive labor market? A perfectly competitive labor market is a type of labor market in which there are many employers that pay the same wage rate to numerous workers. Workers have identical skills and the firms cannot change the wage rate. A minimum wage is the lowest wage that can be paid to a worker. It is a way government intervenes to protect low-paid workers. The equilibrium wage rate, WE, and equilibrium quantity, QE, are obtained from where the demand for labor and supply of labor are equal. When the government introduces a minimum wage, the wage rate rises from WE to WM. The quantity of workers employed drops from QE to QM. Why a minimum wage may reduce employment level in a perfectly competitive labor market. Minimum wage raises costs of production and makes businesses to reduce their workforce. Without that, businesses may record losses, which can lead to closure. If labor can be easily substituted with cheap capital, firms will reduce their demand for labor following the introduction of a minimum wage. Finally, a fall in the demand for the product, which occurs when a minimum wage is introduced, will cause a reduction in the demand for labor. Why a minimum wage may not reduce employment level in a perfectly competitive labor market. A higher wage motivates workers and improves their productivity. A rise in productivity is shown by a rise in marginal revenue product, MRP. Because of increasing productivity, businesses will need more workers even though their wage expenses have gone up. In addition, a rise in demand for the underlying product will increase the demand for labor. The employers may not reduce their workforce even if a minimum wage is introduced, because it may be difficult to replace workers with special skills.